Major funding for these broadcasts has been provided by grants from New York Community Bank, Capital One Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Terra CRG, Meridian Capital Group, the Witkoff Organization, Ariel Property Advisors, Chase Commercial Term Lending, Chase Mortgage Lending, Perfect Building Maintenance, Genova Burns. Additional funding has been provided by AKA Hotels Corming Communities, AmTrust Title Insurance Company, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, Collins Building Services, ConnectOne Bank, CPEX Real Estate Services, Dime Community Bank, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handro Properties Handler Real Estate Organization, Hersha Hospitality, Hodges Ward Elliott Inc., iFunding, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Polsinelli, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, the Knackle Group at Cushman & Wakefield, the Continuum Company, the Moynihan Group, and These Friends.
Money. Is there money for real estate? You know, people say that there's a lot of money out there for commercial real estate, but the rumor mill said there's difficulty. There are regulations that banks have to interplay with today. And, you know, so where's the money coming from? So today I've assembled this group of bankers and business leaders to provide their insight on, is there money for real estate? I have Gregg Gerken, who is the Executive Vice President, the head of U.S. Real Estate Financing for TD Bank. I have Ronnie Levine, who is a Senior Managing Director at Meridian Capital. Peter Sotoloff, who is the Managing Partner and the Chief Investment Officer at Mack Real Estate Credit Strategies. And last but not least, Frank Sorrentino, who is the Chairman, President, and CEO of ConnectOne Bank. So I have two bankers, one intermediary, and one in between. You know, you're a man, you're a private equity, you get money from a variety of places. So how active are you?
It's a robust market. Given the regulations you just mentioned, we're finding a very full pipeline, and the impact those regulations are having on the traditional providers is giving us an ample selection of product.
So as opposed to me playing inside baseball, what are the regulations that are taking place today that are allowing him to be more busy on you? You're the two bankers over here.
Well, I think in any pendulum swinging from one direction to the other, back in 2008, you saw the pendulum swing towards more regulation, Dodd-Frank coming into play. And it's created not only pressure on the banks in terms of where they can lend, but it's also increased the cost of lending because the amount of capital that's required for a bank to maintain has gone up significantly. And I think that's opened up plenty of opportunities then for the non-bank lenders and alternative sources of lending.
Where do you see the market today?
So we see, very similar to what Peter sees, great opportunities for a bank like ConnectOne or TD that have the ability and have the liquidity and the funding to be able to go out and do lending. And I think that's still providing a tremendous amount of tailwind to the industry today. So I do think there are regulatory headwinds, though, that are tempering some of that for some of the institutions, specifically here in the Northeast market.
Are we okay? You're what? How big of a?
We're 4.3
You're
billion.
4.3 billion. You're on one side of the regulator. You're on the other side of the regulator debate on your side. How do you see when you're dealing with the other banks, the foreign, the German banks, the other foreign banks, the Chinese banks? Where are they in the financing market? Are they worried about the regulators or?
Well, yeah, I think they have their own regulatory issues that they have to comply with. There's Basel III, and there's a whole host of other regulations that the foreign banks need to comply with. To a certain extent, our regulation is really just mimicking what was done in Europe. So I think that the foreign banks are, certainly concerned with leverage. A lot of them comply with HVCRE, high volatility commercial real estate, which is really some regulatory issues that come up in terms of leverage. Borrowers have to have 15% of the as completed value of their project in as cash equity. So, that is, forcing more equity to go into projects and kind of making the capital stack on the higher leverage deals a little bit more challenging to navigate. You're seeing borrowers that used to take mezzanine financing, maybe structuring that mezz as preferred equity because the mezzanine tranche counts towards actually as debt and not equity in the deal. So. But to your earlier question, I think, echoing the prior sentiment, I think there's a lot of liquidity in the market right now. From our perspective, it's navigating and finding the right source of capital for each deal. And from where we sit, it's really a pricing exercise of trying to pair up the appropriate kind of risk-adjusted capital to each project. But we're certainly seeing a good amount of liquidity in the market. But I do think the one sector of the market where I kind of see the least amount of capital flowing to is construction. And I think that's really where we're seeing some pullback, which is creating some opportunities for firms like Peters.
Where do you see it? Where are you in the construction?
We're pretty bullish in the New York metro market in construction. It represents somewhere in the 12-13% of our balance sheet. And we still like the asset class today. Very, very cautious about what we're doing, who the sponsors are, what the type of project is, and making sure it's someone who really understands what they're in. No first-time developers or anything like that. So
prior to the show, I was talking to Gregg, and we were talking about construction financing for condominium, and you said your exposure is rather minimal.
Yeah, it represents about 3% of our overall real estate exposure, which is less than in total 1% of what the bank's total assets are.
So how do you look at it? Frank said he's relatively bullish depending on the sponsor and depending on the type of project. How do you look at it today? Certain lenders today, even large lenders like New York Community Bank, which is a $50 billion institution, they won't put out construction financing.
Yeah.
They remember the other days, and they said they'd rather put out lower price multifamily financing. It's question of risk reward. How do you look at the?
Well, let me differentiate, because what we were talking about was for sale housing, and that represents that less than 3%. Overall in construction, we're probably about 15% of our total real estate portfolio is in construction, but where we haven't been doing as much in the for sale space, which is very much dependent upon units selling, and you don't have the pre-sales in every market that you might in some.
I'm really gearing myself to the metro market,
Yeah.
the New York, New Jersey, Connecticut area. You're the alternative lender. You're the kid who doesn't really have to deal with regulators. How do you? Where are you? What type of deals are you doing in different areas?
We've been, we've been a beneficiary of the regulatory movement. Clearly, Basel III, Dodd-Frank, Solvency II, HVCRE put some very positive tailwinds. But I do think the regulations have had the intended effect of really banks being more protective of depositors' money and the people that they've been entrusted with, and move that risk to folks like ourselves that have 300 people of infrastructure, a 50-year history of development, and have the requisite infrastructure to price, structure, underwrite, and asset manage that risk. And I think it's really had a very positive
As we
effect.
would say in the proverbial situation, loan to own, in case you have to.
I would say yes, but we really have a bad.
It's not your. It's not your mantra. You can take over the property.
We have the capability, but I would tell you that back to sponsor selection, our average loan is about $200 million, all major markets. We deal with, I would say, very credible institutional borrowers. That is not a good outcome for us. Not that we don't have the ability to, but it is not the first and foremost strategy to realize the asset upon their failure. It is really about being with folks in markets where capital values and demand stays intact, where there's natural regulators to supply.
So you could even be in a deal with Gregg on the capital stack if you're talking about a $200 million deal, with a little level pricing. Yeah.
All the commercial banks like Gregg are partners with us, and what the banks have found is, under the regulatory pressures, is that they can, after I make a loan or at the closing table, they can get very good treatment being at 50% or below on what I call transitional assets. And a lot of people confuse transitional with a construction loan. Frankly, that's the exception, not the rule. It could be an office lease up, something that is an older building going through some type of repositioning, a lobby, a facade, et cetera. Just because it lacks cash flow, characterize it under the regulations as a transitional asset. The most extreme is a construction or land loan. And what I would say is that banks today, like us, don't think that it's fair to broad brush all those types of assets as higher risk. They just are going through some type of value add or metamorphosis. And so we're able to solve, through our existence, the requirements under the regulations that Gregg and his team have to face and insulate them from that risk, while providing for the borrower the ability for them to realize the return on equity and other types of requirements that they have for their investor base. So it's a win-win.
Look, I mean, I think that what Peter's firm is providing is really a one-stop shop solution to a borrower that it used to be I would go to Gregg for a senior mortgage and then shop for a discrete piece of subordinate financing and then put the piece together. I think where Peter comes in and commits to the entire capital stack, and they will take it down and distribute the A-note either post-closing or close it simultaneously or put it on a line of credit. So that really is insulating the borrower from basically two financings. And from Gregg's perspective, when he looks at the deal, it's a baked deal. He knows that he's got Mack in the subordinate piece, which allows him to not only look to the borrower, but now he knows that he's got Mack in the capital stack as well. The economics are nailed down. The underwriting, a lot of that, the underwriting package that he needs, he can leverage the work that's been done. Obviously, they'll do their own underwriting, but they're going to get a complete package. All the third-party reports will come in, and they can then do their due diligence. So I think it really, it's an ease of execution, and we've found working with firms like Mack and other finance companies that are kind of providing a one-stop shop solution really makes the process a lot more predictable for the borrower.
A couple of months ago, I had a show, and I had somebody from Carlisle, and he said they joint venture partner deals. He said he prefers to deal with the latter, with the Mack and some other people, because it's more flexible than certain of the banks. Now, how do you look at deals working with private equity funds and so on?
We do. It does not absolve, as Ron said, the bank from doing its own due diligence and preparing its own underwriting package. And that's one of the places where I think the regulators today are being especially tough, especially on some of the smaller institutions that are, sort of delegating some of that underwriting, to some of these other firms, and that's not going to fly today.
The top financial institutions that we deal with still, the onus is on us as the backstop party on these facilities is that to understand the structure, the types of guarantors and other types of mechanics that are going to be responded to favorably. And so we do a lot of repeat business with these banks. We have regular documentation, but we have to stay on top of all of those regulations in addition to bank policies. We talk to them on a weekly basis because clearly we need to make sure, and they're very sophisticated, they do a bunch of their own work. They just find that the regulations have shifted and made any type of loans that have transition above a certain LTV or even at all in certain circumstances, very costly from a risk-weighted assets, cost of capital perspective. But the onus is still on us as the provider to underwrite to their standards of structure and excellence.
But Mike, you see every day there's a headline of another financial institution that's either facing the regulatory buzzsaw or has made the choice to sell itself. And so a lot of the smaller players in the New York market are just unable to survive doing this type of business.
What's also a really interesting statistic is overall bank share of the entire 3.6 trillion real estate market in the U.S., bank share of lending is actually up. But the transitional component, anything that's construction or lacks cash flow, is actually down from prior peaks in 07 and 08, down about 53%. So banks are providing a lot of liquidity today, but it's in a different type of environment, a different type of structure.
So let's talk about type of assets. We were talking, one of the hardest assets to finance is hospitality, because it's basically the cash registers each and every day. You got to get the new customer in. How do you look at, and I want to go over a couple of markets, hospitality, retail, food business in general, fast casual of a chain as opposed to a specific retailer, the office market, and this co-working, co-living type of market.
And interestingly enough, if you look at how fast the markets are changing, real estate itself is an asset that goes back forever. There's really nothing new to it. But when you think about the dynamics of how people live, how they choose to work, certainly what their retail habits are today are changing, and probably changing faster than any of us would have predicted or actually can even predict in terms of what's going to happen. Retailing in particular is rather interesting, and I think it kind of mirrors what we said before about the suburban office market. There's probably too much of it. It'll eventually have to get rationalized in some way, shape, or form. But again, nothing beats a good location, and I think that's really what's driving most of the decisions.
But with regard to retail, and let's talk about suburban retail. We've had A&P go bankrupt, which was 4 major supermarkets over there. We've had difficulties. Today, Amazon is delivering. You have Fresh Direct, you have Amazon, you have other things, and then you have the discount department stores that have gone bankrupt. So you have retail shopping centers that at one time you wanted a grocery-anchored shopping center. How do you look at a grocery-anchored shopping center?
Well, we used to say in some of these smaller retail centers, if it had a lot of food exposure, you didn't want it, right? It was not what you wanted. You wanted the Circuit City and Best Buys and all these other chains. Today, we actually look for exposure to food, whether it's restaurant or fast casual or something else, and you say, okay, now I'm comfortable with it because it has a food exposure, because you can't Amazon that away.
What about the gyms? There have been a very large number of gyms opening up, and I realize the profit margin, because many people, including my buddy over here, joins these gyms, okay? And what happens is it's really an annuity for the gym, because they put it on the credit card, and people, if it's lower price like the Planet Fitness or the Blink, they say, hey, it's $25 or $20 a month. They forget about it, okay? And these clubs, there's no way that some of them could ever fit in the number of people who are members over there, but it's a volume business. How do you look at a gym for financing?
And, those memberships are workout optional. It doesn't cost you that much, and if you want to take the option to go work out, you can. It doesn't hurt you. Those that are more serious about it go to a more serious gym.
But how do you look at it as a banker now?
But from a real estate perspective, it's like any other tenant. What's the viability, the strength behind it? But we're also watching consumer changes. As grocery-anchored centers have been replaced by restaurant-anchored centers. So have a lot of these large, big block spaces have been replaced by a gym. It draws traffic, and I think from the landlord's point of view, as long as they have somebody paying the rent and it's drawing traffic to the center, they look at it as a positive.
My favorite one is in Paramus, where the movie theater was replaced by the gym and the Miller Ale House right next door that serves burgers and beers.
Well, look, in the city, fitness concepts have generally filled space that was not attractive to other retailers. So you have gyms going into basement space or other space where generally they weren't revenue producing. So I think urban versus suburban, there's a different answer to that question. I think certainly in the city, you're seeing an evolution of fitness concepts towards a lot more of these smaller studio concepts, a lot more boutique type of experience, and I think that'll eventually filter out into the suburbs. But right now in Manhattan, I think there's been a shift away from the very large gyms to the more boutique type studios, whether it's CrossFit or any of these high intensity interval training type concepts. I mean, they're popping up all over the city. So I think those are, an evolution in fitness. So I think that,
I mean, as compared to the lifestyle fitness, which is out, up in Westchester, this 200,000 square foot huge facility, and they opened up one in Joe Moynihan's property on 42nd Street, a 70,000 square foot.
You generally in Manhattan, you just can't afford to get that kind of scale. So, I mean, I think, you can't really do that absent a few locations in the city. So I think the trend in the city has been in the opposite direction towards smaller. I mean, in the suburbs, you have, the available space to make these monstrous facilities with the basketball courts and, and all the other concepts and under one roof. I haven't seen really that in Manhattan as much other than like a Chelsea Piers type of concept.
What about the transit-oriented developments that we were talking about before in New Jersey and the Westchester markets?
We actually love them. I mean, if we had to pick what multifamily we'd like to be involved in, transit-oriented comes to the top of the list every time. And we've seen in every major market that has and relies on the commuter, those projects have leased up faster, in most cases faster than the pro formas, at rents higher than what we've underwritten and projected, and frankly, when you look at the concept of do you want to sit in your car, do you want to have the option of taking mass transit to work, I think it wins out almost every time.
Yeah. The employers, obviously millennials, the type of amenities, transit-oriented development, transit, access to transit is very high on the list. And similar to Gregg, we have some large loans outside of DC that are right on the Silver Line.
Yeah.
And the sponsor, to their credit, chose the site right on that metro. And those have leased well ahead of time and budget.
If you look at the largest tenant who took space last year was WeWork in the co-working. And we have about today probably 25, 30 companies, and some of these co-working places, they call it the enterprise system. They have companies like Hewlett-Packard and pharmaceutical companies who are renting space. But people forget that Regus in the last recession went out of business. How do you as a banker and as a lender look at the co-working thing?
We're not looking at that co-working metric to determine whether or not we want to lend on that piece of real estate. At the end of the day, it's a piece of real estate, and that may be the highest and best use today. That may not be the highest and best use tomorrow. There's an operator function there that we're just not that comfortable with today, and we want to know that we can fall back to a more standard use for that space. It's not transferable. If WeWorks doesn't work out, I don't think the landlord just continues operating it the way it's operated today. They have to find another tenant, and I think we have to look at that.
And they have to re-tenant the space and
Yep.
fix up the space.
The key for doing any kind of transitional lending is really figuring out what the alternatives are and being comfortable in the real estate at a basis with the proper structure, similar to Frank's comments, that if there is an alternative use that needs to be required or alternative tenants, how do you feel about that in a bad time?
What's your thoughts about Staten Island, Peter? Anything?
Look, we've looked at a number of projects. I would say, our program and our investor base is generally focused on 24-hour, 7-day-a-week cities, major markets of activity, and just the sheer size of the projects.
It's too small.
Yeah, but look, we've been approached with a number of them, and we keep an open mind.
How do you look at it, Gregg?
Well, listen, we have a fair commitment to Staten Island. We've got stores on the island. We've got a lot of clients on the island, and where we see, again, a transit-oriented type project or what we feel would be a good investment there, we're going to invest.
Yeah, I mean it's a good community. We have good solid assets there. I think from our perspective, with the things we like to lend on, there are better places that we'd rather be in.
What about Jersey City? We were talking about that before. Jersey City has become a very important situation because it's transit oriented. It's very close by. I mean, from Lower Manhattan, it takes 15 minutes on the train. But the big question about Jersey City is the enormous amount of units coming on board.
Yeah, no, a lot of supply. The question is, will the demand meet up with the supply that's coming on board? There's thousands and thousands of units. That's a tough thing to do. The price point is definitely different than here in Manhattan, but nonetheless, it's a lot of supply, and it's a very big market. It's not all the same market, like when you talk about a Williamsburg or you talk about other markets. Jersey City has a tremendous amount of sub-markets there.
You bring up an interesting subject. People today with Williamsburg, with the L train possibly closing for, when they say a year, we know New York City a year is never a year. It's 2 to 3 years. Merchants, retailers, people are a little worried about that.
Yep, they are. They are. It's affecting some of the projects that are, somewhat on the outskirts that don't have a secondary means of transportation. I see it. We feel it. But I think at the end of the day, it's a somewhat temporary situation.
You know what? It was like the Second Avenue situation that for years, you couldn't do anything. It's finally going to happen in December, but it took a little.
Except the train doesn't fit in the tunnel. Other than that, it's great.
It's.
But there's light at the end of the tunnel.
There's light at the end of the tunnel. Where do you see the greatest opportunities to lend?
Well, we've had no, and I think everyone here could say the same thing. There's been no shortage of opportunities.
No, I agree, but if the greatest opportunity, is it to lend to in the multifamily arena? Is it to lend in the office market? Is it to lend in the industrial market?
I think it's you can pick any of the above where there's demand, and if we look at the sub-market that it's in, and we feel pretty bullish on the demand, a transit-oriented multifamily, we do all day long. We just participated in the One Vanderbilt project, as both a tenant and as a lender, and we see transformational projects like that, and they're certainly around, and you can find them.
What about the areas around the Hudson Yards? I mean, the Hudson Yards has been done very effectively, with pre-leasing and everything else. What do you see? Because people forget that the area in the Hudson Yards, which was zoned, is also from 35th Street to 42nd Street.
Well, I think it's a new market that is developing. It's developing fast, and it seems to be absorbing pretty significantly. It's also a different alternative because it's a lower cost alternative, and I think for those folks that are a little more price sensitive from an office point of view, that it's a good alternative from a live, work, and play. The more the neighborhood develops, the more it becomes an alternative.
And I think we're seeing that in the price expansion that's gone on there in that market.
So I think in essence, as I started the discussion off, is there money for real estate? There is. We understand the types. We understand where the pricing is a little higher depending because of regulations, but it's continuing, and as they would say, the world is not coming to an end. And I'd like to thank Gregg, Ronnie, Peter, and Frank, and I'll see you next week.